15-1 on uncollectible accounts receivable. We're going to go over various types of things in this, but I want to give us an overview first, which is that we typically sell products or services to customers on account, and when we do that, we debit accounts receivable and we credit sales. And our expectation in the future is that we're going to collect that receivable. However, we know that reality is that some people just aren't going to pay. They may be deadbeats, their company may be having a difficult time selling things and collecting themselves, so they can't pay their bills. There are a lot of reasons that they may not pay. So there is a really important principle in accounting that is called matching expenses with revenue. And what that says is that we have to record the risk that they're not going to pay as an expense in the same accounting period as we record that revenue or that sale. But the problem is if I sell you something today, I'm not sure whether or not in the next month or 3 months or 6 months you're going to have difficulty and not be able to pay me. So an estimate is involved. So as you're looking at this, you can see that we're going to say what the purpose is. We're going to estimate what the uncollectible is, and we'll give you a method or two to that, and then we'll record that entry in our accounting records. So let's talk about a few overall things first. So let's start with the obvious, which is accounts that can't be collected are called uncollectible accounts because, again, we're not very creative as accountants, so we call it uncollectible. And you'll hear it called bad debts a lot. So either uncollectible accounts or bad debts. And when we estimate what this amount is, we are going to credit an account that is called allowance for uncollectible accounts. This is a contra account to accounts receivable, so I'd make sure and get that in my notes. So accounts receivable is a normal debit, so the allowance for uncollectible accounts is going to be a normal credit because it is a contra account to accounts receivable. But when we do this estimate, it's called the allowance method of recording losses. On this next slide, what I would want to know if I were you is that the book value of accounts receivable, and the book value for all accounts are an assets account balance minus its related contra. But for us in particular in this chapter, the difference between AR and the allowance for uncollectible is the book value. It's what we believe we're going to get, and I think that's on the next slide. It's our net realizable value. So AR minus allowance for uncollectible accounts equals our book value, and that book value is what we think we're going to collect related to all of those customer receivables. So that's the overview. So now there are two different methods for estimating uncollectible accounts. The percent of sales method and the percent of AR method. Sales is an income statement focus. Accounts receivable is a balance sheet focus. And the percent of sales method assumes that a percent of the credit sales will become uncollectible. And when we say credit sales, we mean the ones that are on account, not the cash sales, because we obviously already collected the cash on those. So only the ones that are on account, we assume a certain percent of those sales will become uncollectible based on historical data. And then there's the percent of AR method, which uses an analysis of accounts receivable to estimate it. And this analysis is called aging method. You're going to see me and people out in the industry call it the aging method typically. This is the most common method used. It's the only one I ever saw a client use. We never use percent of sales. So most people, most companies use this method. So let's talk a little bit about it. So again, when we analyze accounts receivable according to when they're due, it's called aging it. So if it's due at the end of the month, how many days past that due date is it past due? So let's look at it in terms of the schedule that we have here, which will hopefully make a little more sense. So this schedule is as of December 31st. So at the end of the year, we have all these customers who owe us all of this amount. And for instance, someone like Belk and Jensen, they owe us $32.47.36, but it could be made up of lots of different invoices, so we've shipped them things at different times. So what the current column is telling you, and I would take notes right on this sheet. You should have this sheet that I gave you at the beginning of the trimester. So the current ones are the ones that they haven't met their due date yet. So if we were 2/10 net 30, we're still in day 10, 11, 12, 13 from the invoice date. So it's not past due yet. It's still current. So they're not really a big risk to be uncollectible. Another invoice, however, might be 1 to 30 days past its due date. So we have these, we call them buckets of 1 to 30 days past due, past the invoice date, 31 to 60, 61 to 90, or over 90 days past due. So we literally, for every single customer, go through and figure out for every invoice if they're in the current bucket, not past due, or 1 to 30 days, 31 to 60, 61 to 90, or over 90 days. And we do the schedule and we add each of these buckets up. So our current bucket's 11,000, 1 to 30 is this, and all of these add up to our 20,381. So then, based on historical experience, we go through and we say, typically, who has not paid us and what percentage of people have not paid us. So as you would expect, the longer it's past due, the higher the percentage we think won't end up paying us. And the people that are current that aren't past due yet, we don't think a lot of those are going to become a problem. So as you would expect, as they get older and more past due, the percentage goes up. So what we do is we get this schedule then, and we do our aging groups, our buckets. We copy these balances. So current was 11,774, and the percentage is here. 5 down to there, 4 to here. So we copy all those amounts and percentages, and then we just do it mathematically. So we take 11,774 times 1% and get that, 57,05 times 4 and get that. And we do that for every bucket, and we then add up our entire amount of uncollectible that we think currently out of that 20,000 is not going to pay. So this is what our expectation is of what our estimate should be and what our account, called the allowance for uncollectible accounts, ought to have in it. However, you see out here the current balance in the allowance is $125. So what we're saying is it's at $125, but we need it to be at $2509.25, our estimate. And as I told you, that's a credit balance. So that's at a credit of $125. I need it to be a credit of $2509. So that means my adjustment that I need to make, my additional is 2384.10. So we have computed the estimate for each age group, the total, and then the additional amount we need to record in our account. So the adjustment that we're going to make, and we just do an adjusting entry, just like we did with supplies or anything, and we will debit uncollectible account expense, which is a new expense for you. It's a normal debit because it's an expense. And we will credit the allowance for uncollectible accounts for that same amount. And that again is a contra account to accounts receivable, and it is a normal credit balance. So after we have made that adjustment, which is showing you there, then you ought to try to calculate the book value of accounts receivable. So the book value of accounts receivable is the $20,381.81 minus the allowance of $2,509.25, and you would get $17,872.56. And what that number tells you again is that out of all of the $20,000 of receivable we have, we expect to collect or realize $17,872.56. That's what we predict we will get. The only other thing that a couple things that I would mention is consistency of principle. Once I have chosen which method to use, percentage of net sales or percentage of AR/aging, I have to consistently use that. Also, those percentages that we used are historically based. We're going to continue to use those unless there is a big indication that those are not accurate. So that's consistency. We got to continue with that period after period so that we don't manipulate earnings. The other accounting concept in this chapter was something called neutrality, and neutrality is all about doing this in an unbiased manner. So having a method to the madness is what we call that. So that I do consistently do it, and I take the emotion part out of it and the desire to manipulate earnings. So those are two big concepts. The only other thing is we did not talk about the percentage of net sales method other than to explain it in general. And honestly, all that you do on that, I'm trying to get back to that. All that you have to do on that is literally take the credit sales that you have and some historical percentage and multiply them by each other. And that is your estimate that you would use in the adjustment since it is income based. So it would be the exact same adjustment that we did where we would debit uncollectible accounts expense and credit the allowance for uncollectible accounts. So nothing different there.